Well, hello, welcome back again. My name is Ann Sheehan, Real Property Tax Advisors, and welcome back to our vlog series, Property Tax 2021. We're getting ready for it. On my last vlog, I made a fairly bold statement, and I've gotten some feedback on that. I basically said that our tall buildings, residential, hotel, and office, that have been the sweetheart of real estate investments are now liabilities. I did not say they were permanent liabilities. I think they're liabilities now and for the foreseeable future. But we've had a lot of lively conversation about that. And as always, what I want to talk about is how we take this change from being an asset to a liability, and how do we get a fair market value assessment for our property taxes for 2021 and going forward. We're not going to settle this all in 1 year. So we need to make sure we stay on top of it and track the changes in the market like we always do. So let's go back and let's look. Evidence of the pandemic is everywhere. As I said before, the pandemic has not been exclusive. In fact, it's been incredibly inclusive, and nobody's been exempt from it. We see empty buildings, we have bankrupt tenants, we have whole companies, state companies of our country that are now bankrupt. We live with social distancing limitations, 6 feet apart everywhere you go. In my home state of Georgia, we actually managed to politicize masks when the governor sued the mayor, the governor sued the mayor saying she could not force us to wear masks. Well, never mind that that's the best way to prevent a virus, right? Moving on. Work from home is now a new normal. And for a lot of people, it's the preferred way of working. Productivity has shot through the roof. Now, companies are trying to bring people back to work. It's a moving target. You know, they said they were coming back June 1, and it was July 1. In September. Well, now a lot of companies just have skipped the fourth quarter and they're saying January. Who knows? We'll figure that out, I guess, just like we've done everything else that's been related to the pandemic. But what I want to really talk about are strategies for 2021. And I think we'll need to work this way for property taxes, at least through 2023 or 2024. I think we have to be diligent when we document how the pandemic affected our buildings, our investment buildings. Rents, you know, concessions, lower rates, free rent tacked onto the back of a lease, vacancies, you know, did people just get up and leave? A lot of small tenants did. And we even have some big tenants that got up and left effectively. Concessions, you know, what kind of concessions are being offered? You know, if you think about it in real life, as a landlord, I'd do anything to keep a tenant because it's going to cost me a whole lot more money and time to not have a tenant, not have that tenant, and have to backfill the space. So everybody's smart, everybody's doing it. We're working to keep our tenants in place, but we're having to make changes. We need to document those changes, because we wouldn't have made them otherwise. That's the whole key. Our operating expenses have increased significantly. We have heightened cleaning, we have higher cleaning standards, we have more cleaning, and all of this is because the tenant is demanding of you, the landlord, that their employees come into a safe place, that they are protected, that they're giving every advantage they can be given to stay healthy and well. 2021 property tax is going to be very different even from just 2020. Here's another thought that I want you to give a few minutes to. The towns and the municipalities our taxing jurisdictions have had financial issues long before the pandemic, and now they're worse than ever. As I said in my last vlog, it used to be we'd go into a hearing, win a case, client gets a refund, checks cut and mailed. It was somebody else's money. It's personal now for these taxing jurisdictions. They're looking at that money differently. Is it my salary? Is it my post-employment benefit? Is it my retirement check when I leave this job of public service? The jurisdictions have been impacted exactly like all of us, and they're thinking like all of us. Just as an example, the jurisdictions can't cover their daily operating expenses. They're still, and this has been true for decades, so burdened by underfunded post-employment benefits. It was a great idea 40 years ago to set up benefits for retired policemen and firemen and just create a fund and have it out there. And the fund would grow and it would pay everybody and it would be good. Well, when you don't pay into it regularly, it can't grow at the rate it needs to grow. So that's our problem with the underfunded pension benefits. We have employee protection with unions and other organizations that basically add on to the cost of hiring those employees, even though there are benefits for the employees to be part of these organizations. We have some jurisdictions leveraging inappropriate tax increases, for lack of a better word. And the first one that comes to mind is Nashville, Tennessee, right up the road. Their tourism, like many cities in the United States, came to a complete halt in March of 2020. They depend on tourism. They always have, and especially with the notoriety and visibility that country music has brought to that town. But if there are no tourists, there's no tourist revenue. And the mayor actually announced on TV that he was increasing property taxes 34% in Nashville to make up for the revenue that they weren't getting from the tourists. That's not how property tax works. Needless to say, Nashville pops up quite frequently in property tax conversations. Another thing that's been different that we need to pay attention to is most companies file business personal property returns. And manufacturing companies, particularly, their returns are enormous. I mean, we file some with assets over $100 million, $200 million. I mean, they're huge. All of a sudden, the jurisdictions are going in, looking at these returns and increasing the values. Well, personal property is really just an accounting exercise. You put the cost, you depreciate it, and you calculate, you add it up, you're done. Well, they're now going after them in a much more focused and proactive way, because every increase could result in an increase in a tax, which would help them out. San Francisco, being in California, which already has a crowded docket for the November election, and it's not just the presidential election. They have several significant property tax proposals that will be on the ballot. One of them is Prop 15, which will replace Prop 13 for commercial real estate over $1 million in value. And Prop 13, if you don't know, says that what you pay for your property is what your assessment is, increased no more than 2% per year. So if you've been in that building for 25 years, your assessment's pretty low. 2% doesn't keep up with the market. So they're cutting out that segment of commercial real estate that's over $1 million in value, and they're going to tax it. They're going to value it every year and then tax it. So people could potentially see increases of hundreds of percentage points. It's going to be ugly, but it's on the ballot. And there's another one that's on the ballot just for San Francisco, but they have gone in and secured enough signatures to add a proposal to increase the sales transfer tax for any property over $10 million 2 times. So it's currently about 3%. They say they want it at 6%. Well, start doing some math. An extra 3% on a $10 million deal or a $100 million deal, it could be enormous. It's a source of revenue. It's one of those property tax, state and local taxes rather, that most people don't even pay attention to. But if this gets traction in San Francisco, we will see it again. So there are a lot of moving parts for 2021. And I think, and we've talked about this as a company for quite some time now, I think that 2021, I think we need to approach it differently than we have for a normal year, whatever a normal year in property tax looks like, I guess. But anyway, I think we need to be very proactive. You know, we have landlords are suffering, tenants are suffering, even owners of buildings, manufacturing companies, their suffering is a little different, but it's still there, and we can still help them with that in 2021. But I think and the biggest thing is going to be the jurisdictions themselves. They're going to be in a protect mode. We've already seen it in 2020. They are so protective of their roles because that's what pays the bills. And it will be even more protected next year. So we have to be proactive. My guess is we will have to engage an attorney long before we ever walk into just a hearing. I'm not talking court, I'm talking the first level hearing. I think we will have to do that on buildings that have significant value. I also think that it might behoove us to maybe have some appraisals done for property tax purposes. And remember, an appraisal done for property tax purposes is not like any other appraisal. Property tax is a 1-year value. It's not discounted cash flow for over a 12-year hold. We don't do that as a rule. But I think an appraisal might be a proactive investment that we can make in the appeal. Finally, I think we're going to have to explore the possibility of using expert witnesses to testify to some of the finer points of valuation. And this really shows up more in personal property than in real estate, because real estate is a lot simpler than personal property, believe it or not. But I think it could happen in real estate as well, where we may need a different kind of expert witness to verify what we're saying the problem is with the property and the issues and why the property has gone down in value. So with all these changes, everybody's just seeing dollar signs, right? I'm seeing them, you're seeing them. I think probably the most important thing that our company is going to do in this strategy is, we've always done this, but it's going to have a new focus, is provide cost benefit analysis for our clients, so that we can estimate, okay, here's the potential savings that we think is possible. And then this is the cost of pursuit, if you will, and include our fee, attorneys, whatever we end up putting in there, just lay out the costs that will be part of that pursuit, and make sure that it's beneficial to the client to go this route. Not every appeal needs this much attention, but with our company and our national footprint, we handle a lot of very expensive buildings. And I really think that this is something we're going to be doing more of rather than less of. So there you have it. Those are some of the strategies for 2021. We've identified a few of the changes, certainly from the jurisdiction side of the table, and what they're dealing with, and how they're going to present in the hearing room. If you have any questions, you know where to find me. Otherwise, I will see you next time as we continue on with Property Tax 2021. Thank you.